This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it's great to have Cullen on the show. It's always great to get his insights. I look forward to hear just pulling up some charts and putting some perspective on some of those views. Let's have a look at it.
Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, click the red button that says Looking for the Downloads. Patrick, the chart deck is titled Breakout. What do we have on page 2? Looks like the S&P chart.
Right. So I want to start with actually page 3, where we highlighted past market corrections and the kind of bear market rallies, not bear market rallies, or at least the reactionary rallies that happen midway through the corrections. And each of them lasts sometimes as long as a month and often have multiple legs higher that mean revert a good chunk of the market move. Now, I'm not in any way saying that that's guaranteed to play out this way, but when we go to chart 2 and look at this chart, when you draw just a descending trend line along the previous highs, it looks like today's candle is a breakout bullishly to the upside. That typically is going to spur many traders to want to get long this market. But if we use the analog of that previous chart, we're actually at a very sensitive moment as we get into the next like 20 to 50 S&P points higher, because if this continues to be a prolonged market correction that may have one more corrective leg left in it, then we should see that the S&P 500 starts to struggle to make much more progress than it is today. And the only way that I really think that the bulls are really in the clear is if there's some legit bullish follow through and we see some of that sector rotation that's been coming out of things like the FANGs and NASDAQ start to really rotate back in. And it's certainly a possibility that the bulls may take control, but I still think the jury's out, and I think it's going to be a very important week next week to see whether or not there's any follow-through after we roll off the October OPEX.
Well, I couldn't agree more, Patrick, that next week is really important, and we are at kind of a pivotal moment here. The place where I might disagree slightly is I just admit I have no clue which way it goes from here, because I really think this market is tired and needs to go down. But look at what the last several years have shown us. About every time I think that's the way it's supposed to go, it seems like all this central bank largesse just fuels more and more asset price inflation. So I certainly don't want to be short here. I'm happy to be trading crude oil on the sidelines.
You know, the one pushback that a lot of people have on the bull advancing from here is the fact that we're really entering a phase where monetary policy may start to tighten with some tapering. And if we had a market that just kept rallying, I think that would be a green light for the Fed to actually tighten policy. I'm wondering whether or not the market needs to have a little tantrum in order to get the Fed to kind of back off from its current policy. And I mean, that's certainly the argument to be made that the correction could continue, but we'll see. I mean, that's I think it won't take more than a week or more to find out really what's the market has in store. Nonetheless, let's jump to the U.S. dollar chart that we were talking about in the market wrap earlier, showing there those October, November highs of the dollar index. And interestingly enough, at least the dollar's bumped its head here. But I really think that beyond a quick little pullback that often is like 1.5 points here, it'll be really interesting to see whether it's bought on dip and defended. I mean, when we go and think back to what Russell Napier was saying about the dollar and making a case that there's room for the dollar to strengthen, it'll be really interesting to see whether characteristics of bull trend remain in here. And one biggest characteristic is all dips get bought. And so as one of these corrections comes in, it usually is a really big tell to see whether or not it's accumulated quickly on any weakness.
But in any event, Patrick, let's move on to my favorite chart, which is crude oil futures. I've been dying to ask you about this one because when we talked to our listeners back in April or so, I was saying, boy, look at that nice big bull move from November up through the middle of March, and then we saw a correction and a lot of big rallies. You'll see a pattern where you get about halfway through, and then there's a significant correction at the midpoint, and then you get the second half of the big rally. I thought that was the halfway point in March there, Patrick. I'm starting to think that this July-August correction is the real halfway point. And if you do a measured move on that, you end up over $100. What do you think?
Oh, that definitely is the bigger measured move. But that's more realistically like a 6-month target. And I think that before we start targeting 100, I think the first thing to see is where a new midpoint occurs. So my view here at this stage is that it's very easy for crude oil at this point to even temporarily punch up toward $85. At some point, we're going to have a scenario where the rally is checked, and there's going to be some sort of a reactionary correction that just washes out some short-term trend chasers, and it creates a base. If that shows that the price is being very well defended, that could be the platform from which a launch to 100 could really happen. But I think that 100 is more now a 2022 story. Really, I think the key here is that how much more gas is in the tank for a punch higher before we see a consolidation. I think 85 is possible. Maybe 90 is pushing it, but I think a few dollars is definitely still on the table.
Patrick, let's move on to the energy ETF on page 6.
Right, and what's really interesting is that we are seeing energy stocks really participating. Now, it is a mixed bag. There are certain sectors of this that are within there that are not fully punching new highs yet, like, for instance, oil service stocks and other sectors haven't yet, even the refiners have not really punched to new highs. But we are seeing that these energy stocks are playing game to the upside. This certainly does leave the window open for them to continue higher still. Maybe we're going to see 110, 115 or even higher on this. What will be really interesting to see is whether this trend of energy companies participating with oil price continues. And that's right now, certainly when you own a stock like or an ETF like this XOP, it certainly has given you proper participation on the upside.
Patrick, let's move on to gold futures on page 7. Boy, bumping right up against that descending trend line. Are we going to get through it this time?
Yeah, I know. And then there's the 100-day moving average you were referencing earlier. That's all at this. It's just such an important moment on gold. Every time we've seen gold have one of these types of pops over the last 6 months, each time it faded the rally. And this is going to be one of the big tells. At some stage when a trend transitions from distribution to a new bull trend, you see that the old dips start being defended and the price action starts to roll up off of small dips. And so this breakout itself is really worth paying attention to. But what's going to be the real tell is, will we see that by next week we faded the entire breakout and we're back to 1750, or do the bulls follow through this time? What is interesting is when we go to page 8 and look at the gold miners themselves, that descending trend line has definitely bullishly broken out. And more importantly, the entire September sell-off in the GDX has now been wiped out to the upside, which is typically a characteristic that you would see on a turn point. In many cases, a lot of traders will chase the miners themselves and front run the gold move. So maybe this is sort of a canary in the coal mine that gold might be turning the corner, but I never trust 1 or 2 days in a new trend. So the next week is going to be incredibly important to determine whether or not these bulls have follow through here.
Patrick, I couldn't agree more with what you said, but I want to go back to page 7 for a second and just get your read on where this is headed. Because the way I see this is, you just said a moment ago, we need to see a break here around, approximately 1800. We need to get above 1800 and stay there for a few days. That gives me confidence that, okay, maybe finally this is, going the right direction. I would then be saying it's about 1920, which would be that high from back at the end of May or beginning of June. If we can get above that and stay there, to me, that would be the signal that says, okay, now it's really game on. We're in the next leg of the bull market, and maybe we're headed to 2,500 or whatever comes next. Would you agree with that, or how should we read the cards as far as what comes next in this market?
Well, sure. I mean, a break above 1920 is technically going to be a confirmation, but that's not when you should be doing your buying. There's often not a lot of asymmetry if you're waiting for 52-week highs to start brand new buying. I mean, really, the way I look at this is that gold just needs to demonstrate the characteristic of higher highs and higher lows and price action defended and everything rolling up. Then you could put money to work here. And then in the much bigger picture, like on weekly charts, whether gold's heading to 2,200 or 2,500 over the course of a year or two, those kind of moves would be confirmed by a break above 1920. But that by then it will be a full bull move. I don't think I'd wait till there to start buying.
Well, Patrick, I've been watching the MacroVoices email inbox, and we're getting listeners writing us saying, how come you guys have never covered uranium? Don't you know anything? Uranium is hot now. You should cover it. Actually, folks, we covered uranium back when it was time to buy it. That's why we haven't covered it recently. Let's take a look at the chart, though, on page 10.
Well, for sure. I mean, we had some great uranium guests on in the past, but really it is interesting to see this very strong breakout in uranium that happened over the last couple of months. There was an extraordinary rip higher. Often people are suggesting that it was the shift in the Sprott physical uranium fund that has really started to shift the supply and demand in the market. One way or another, the prices of uranium have definitely punched up to the $50 mark, but more importantly, this recent dip has now been bought. And I think that that's the characteristic that suggests that there could be continuation. What is interesting is when we take a look at the actual uranium companies, and we're going to use that North Shore Global Uranium Mining ETF, the URNM, that has sponsored our show in the past, and just show how very bullish this ETF has been. The entire pullback was held to just like a 50% retracement of its prior rise. Bullishly breakout candles ripping right back there. If they can clear that previous high and get it up to the 100 plus mark, maybe this thing has enough gas in the tank for a move to 110, 120 on the upside. Definitely uranium continues to look very bullish on its characteristics, and there could definitely be some more upside here.
Well, speaking of metals and mining, Patrick, let's take a look at copper futures because, boy, I've been asking this question for a while now. I think the argument for copper, long argument, is very, very strong. Bullish argument, excellent argument, except that, boy, look at how far it's gone in the last year and a half. Is the correction over? It looks like maybe it is.
Well, this is the really interesting part, right? So ever since that kind of May-June high that we saw on copper, we have more or less seen what was a solid 3-4 month consolidation as that extraordinary bull run just needed to pause and backfill. That's a very common technical occurrence. But what the key always is to watch is when one of the corrections or consolidation starts to bullishly break out. And there's no denying that the last week, the last like 4 trading session has really put together some really good back-to-back breakout days that really is the first kind of advertisement that maybe the new bull run has started. I think that watching whether or not the bulls can hold these gains and build on it is going to be really important. What's really powerful about this is that if this is a new breakout, this is only the second innings of the next leg of the advance. Unlike uranium, which might arguably be already in the 6th, 7th innings of their move, if copper is breaking out, this is much earlier in the cycle, and there might be a lot more money to be made. And you can really see that when you go to the copper miners ETF on page 12, where you can really see that these copper miners have been in the doghouse for quite a while, with a 20 to 30% correction over the course of those 4 or 5 months. And really at this stage, with this bullish breakout occurring here, a big question to ask as to whether the next leg of a big copper bull market is already underway. That's 100% what I'm going to be watching with my members next week.
And listeners, if you want to be watching with Patrick and his members next week, you can do that for free by signing up for a free membership at Big Picture Trading. You can do that at bigpicturetrading.com or get the data off of page 13 of the chart deck.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.